Hello, ladies and gentlemen. Some modern investing on IBM TV. My name is Sasha Star, and I would like to introduce you my esteemed guests. Let's start with Peter Bent, who is a Wall Street professional, and he's has degree from New York State University. Welcome to the show, Peter. How are you today?
Hey, Sasha.
And also we have Nick Poliveda, who is the founder of IBM TV Network. Hello, Nick. How are you today?
Hey, Sasha. How you doing?
Okay, very, very good. So we are living in some strange situation where, according to all indications, with low interest rates, the market should just march along to new heights. However, the political situation in Washington is, in my way, prevents that, at least for time being. Peter, what's your assessment of this and how it affects the stock market?
Well, as always, I always say everybody's focused on the short run and not the long run. The market's climbing a wall of worry. And as all three of us have predicted, it keeps going up this year. And it's going to probably keep going up because of the long picture, not the short picture. So in the short picture, there's COVID, but that'll go away, or people will adjust to their lifestyles eventually. There's fear of inflation, and we're going to get into that in a little while. I'm going to show you an interesting chart, and talk about incentives. But then the Democrats are trying to pass, wasteful bills, which doesn't help. Although we do need infrastructure. There's concerns about China now. Evergrande collapsed, a major real estate company, the biggest developer in China. And so that they had their debt alone is 6% of Chinese GDP. But China will print the money to take care of it. China's not going to collapse. They're strong. And but the China's really, the Chinese market's been hurting, and that's hurt the market too, because a lot of people have, if the Chinese market, first of all, it's down like 19% by one measure in the last 6 months. It's down a lot more after that. The Dragon Fund, I looked earlier in the year, was down 50% because China's cracking down on technology companies, on free market. Now they've got this problem with real estate. And the reason is because they have growing income inequality, and they have big demographic problems, which leads me to the long term, which is, what's really driving the market, and nobody wants to look at it. First of all, Social Security in the United States, they just announced that now they only have enough money to fund the pensions, the pension fund till 2033, not 2034, because of COVID. So now it's a year closer, and they're saying that if they don't get more money, which they will get, then they'd have to reduce benefits 25%. But every country in the world that I've looked at, and I've looked at country after country, is in the same situation. They have growing populations of old people. They promise pensions to, or at least they promise free medical care. And the medical care is a much bigger problem than the Social Security. So if you have, and then I'm going to open it up to a panel because I have questions, but take a look at this chart. Hopefully I can show it well. This is a chart I made up today of 39 years of the Treasury rates, 10-year Treasury rates. So what you can see is a few different points here. One, I circled all the times that there were Fibonacci adjustments. In other words, the market went down, which it did recently, and then it goes about halfway up, a little more, a little less. This is the most consistent pattern you'll see in the world. It's just heading down. So I took the regression line and I went, I continued it. And you can see that here somewhere right there. And so I've been saying we're going to hit zero in 7 or 8 years. So now I'm saying maybe 9 or 10 because I more accurately pictured it. So, but here's the thing, this is inevitable almost because this whole thing has been stimulating the economy, all along. But they can't keep stimulating beyond zero, or they're going to have to create a new way to stimulate it. And then some people say, oh, then they'll lose control of interest rates. But countries will just do what they've been doing many times historically and do yield control. So they'll just buy debt, just like the Fed right now is buying huge amounts of mortgages and securities. They're controlling the market. So they'll just buy it back and fund themselves. But with the huge debt that's coming, they're not going to want any inflation, any interest rates. Now comes the interesting part. So let's say we're going towards, 0 in 7 years. And this is all just tweaking up and down a little bit and on our way down to 0 or maybe 9 years. First of all, I would predict the market will go up for a few more years. Why? Because we're in a yield desert. There's no place to get any return. So if I can get a small return of a couple of percent, maybe on a dividend stock, maybe get some growth, it sounds great when I can't get anything else with my money and it's sitting in the bank earning 0.4% or less. So the real question then is, what is the economy going to look like of the world? Because the world's going to be in the exact same situation because they're going to have huge debt. What's going to look like in 5 or 10 years when the market stops going up because rates can't go any lower and the debt of these countries is huge, and we have a lot of retirees around the world who are now depleting their savings, trying to keep up with inflation. My prediction is we'll probably have moderate inflation, which is 3 to 5%, maybe even, especially in energy. And then we'll have very low interest rates. So people will still be forced to invest in the stock market. But, it's going to really hurt, in my opinion, retirees and, society. Where do other people think we're going?
Yeah, we have a new guest on the program. We have billion dollars fund manager Shaquille Latimer from Australia, or at least he's based now in Australia for the time being. What's your perspective, Shaquille?
I'm not based in Australia. I just happen to be here because of COVID,
Yep.
and that is my story as it comes to the Australian Tax Office. Peter said a lot of things there. I'll address a couple of them. So, as far as interest rates, well, everybody knows. That's no surprise to Peter or anybody else. I don't believe in tax. I just don't. I especially don't believe in the Fibonacci retracements and wave theory. I don't like them. Now, let me say, I know a heap of traders that are really good at it, that make very consistent profits, that are awesome at doing it. I just can't make it work for me. Now, maybe that's a failure on my part. Maybe that's just because, it doesn't work for me. Like whatever, maybe it's my mindset, whatever it is. But I don't like them. That doesn't mean that you shouldn't use them, because if I tell you that I don't like vanilla ice cream, that doesn't mean that you shouldn't like vanilla ice cream. It just means that I don't like it, right? So, in relation to interest rates, I think that we should pay a lot of attention and put into our calculations the fact that interest rates, most especially US interest rates, are going to be subject to government interference or Fed interference. I don't think, and I hope that I'm correct on this one, I don't think that the United States or the Fed would ever allow interest rates to turn negative, or ever allow, as is the conversation right now, ever allow the US to default, because it's something that you can't undo. A country that can say we have never defaulted on our debt, that's quite powerful. A country that has defaulted, no matter how good their credit rating is in the future, you can't undo it. You defaulted once. And US debt, and I'm not against them. America, for people that know me from other shows, I love the United States. I always, from the very first time I entered finance, I always found it sort of unbelievable that the view was if you held US debt, that was better than money. It couldn't possibly default. That was absolute gold. And I would sort of look there and go, but why? Like, why is it so unbelievable? Why is it impossible for America to default? And people would say to me, well, because the Fed can print unlimited amounts of money. And I'd say, yeah, but that's a theoretical thing. That's a technical thing. US Congress can stop them or can stop Treasury from issuing more. So why should I believe the US will never default? Why should I believe that? Of course, at that time, I was very young, I was very cocky, and I didn't have the love or affection for America that I have today. So I kind of have to stick by that. Like, why should we believe that? Peter brought up another very, very good point, which is aging population, not just in the United States, but around the Western world, actually. We have this issue, and our countries have agreed to pay for this. Where's the money going to come from? Now, I don't believe that they're going to run out of money because theoretically they can just print more and who cares? There's no consequences. But there are consequences, and that's where the problem lies. There are consequences when you just print money with no reason. This is why I, and not that I'm a Republican, but many Republicans support the infrastructure bill, but they don't support the lie, which is human infrastructure. If you want to fund social services, just say that. When you try to slide it under the table and call it infrastructure when it's human infrastructure, it's childcare. It's not that I don't believe in childcare or extended maternity leave or more funding for social services. It's not that. It's just that there's no return on capital. People talk about the GDP. People talk about how much money is being generated in the country. But another thing that people talk about is what's the value of the country, right? That's normally more than what the GDP of the country is. That's normally, let's look at what would it cost to buy every building, every house, every park, every street, every road, every highway. What would it cost us to buy that? What's the value of that? Asset values are always an incredible multiple of a country's GDP. So when you invest, so if I can just briefly finish, when you invest in hard infrastructure, building bridges or maintaining bridges or whatever, you know that there's going to be an increase in the asset value that that country has. When you invest in social services, there's not an obvious asset value increase. So that is a real problem. And I think that that's a more pronounced problem for the United States. If I can just quickly, Sasha, sorry, if I can just quickly say one other thing. Peter talked about Evergrande. So something that I would say is an issue is big Australian companies that the international audience may not have heard of, BHP. Another one is Rio Tinto. They're big Australian mining companies that produce iron ore that they ship to predominantly China. Rio Tinto, one of Australia's largest companies, I think they're actually the second largest company by market cap in this country. They have slid 13% this week, over the last week and a half. Okay? That's a big drop. And that drop is because of what's happened with Evergrande. So, yes, is China doing the right thing or the wrong thing from their national interest? I don't know. That's a political discussion. But what we do know is that China has big impacts on other countries. And although its impact is a little bit more muted in the United States, it certainly has a big impact on countries that are commodity-producing countries. Australia is one. Canada is one. How that interplays with the US economy is going to be a very interesting thing to see. I agree with Peter. I think that the US markets will probably continue on an upward trend, but I'm not sure that that's because of US strength. I think that might be more so buoyed because of US inflation.
Nick, you were not very optimistic lately about the direction of the market. So what do you have to say about
a couple things. First of all, Sasha, good call last week
Is that because Sasha's a better chess player than you?
No,
I
think he's got some information from Russia or something like that. The market was going to go down and the market was going to go up. I'm going, whoa, when he predicted it right. Well, with that, okay, so here's what I'm getting, and this is the problem that I'm having. Now, in my pension business, no problem. We're in fixed instruments. So the market collapsed 37%, which it did in 2008. We were up 4.5%. It didn't make a difference. My individual, it does make a difference because I got a lot of money in the market, not just in fixed instruments. Okay, and this is the problem that I'm also having. This is the calculus. It's not the Fed who makes the decision on increasing the debt ceiling. If it was the Federal Reserve, I wouldn't have a problem. If you on IBM TV, you can
I would. Sorry,
I know
sorry,
you would, but you can see
I would, because the Fed would show a little more fiscal responsibility.
Yeah, we interviewed.
That's the reason why the Fed is independent of government.
We interviewed the Fed.
Irresponsible, Republican or Democrat, government is irresponsible. The Fed is
very responsible. We actually have a 5-part interview on IBM TV where Doug Tillett, the vice president of the Federal Reserve, invited us in Chicago, got to meet their economists, go over their stuff. These guys are really sharp people, period, the end. The people you hear who bash the Fed never met with the Fed. They have no clue what these people are about. I would have no problem with the Fed. But I have a problem. The people who are making this decision isn't the Fed. It's your politicians in Washington, D.C. They're the ones who are going to determine whether they're going to, by October 18th, increase the debt ceiling or decrease it. Leading the charge is Barry Sanders and AOC. So, Sasha, are you going to put your financial future with AOC and Barry Sanders? I'm not. I'm out. Nick, I was just telling Sasha. Nick, I was just telling Sasha at the beginning of the show that I don't think there's going to be a default. First of all, if you look at the history, I saw a chart of the last 10 years.
But you got to assign it a probability.
Listen, how many times we came to the debt ceiling? And every time it's down to the crisis, an emergency, it's going to be a disaster, but they pull it through. Let me put it this way. The Republicans now are saying they won't vote for it, and they may not. But there's enough Democrats who have a choice now. Vote for it or don't vote for it. So, and there's enough to get it through. Now, if the Democrats don't do it and things blow up, it's going to be very bad for them politically. And Democrats almost always do what's right politically, even if it's wrong economically or socially or whatever. That's how they operate because they're politicians. So they're going to do the political thing, and it's going to be difficult. It'll come down to the wire. It might go over, and they'll keep funding it. But there's not going to be a crisis because if it blows up, it'll be on Biden and the Democrats, and they're not going to want that.
Peter, if I can imagine, if I can just make make an observation. Now, again, as Nick likes to point out, I'm not actually American, but I do try very hard to understand both from abroad and when I actually am there. And I know that you have some sense, and you're a normal, rational person. So, if I can just ask you to imagine if you were in a car accident and half your brain went missing, and you happen to become a Democrat, okay? What would you do in this circumstance, where you know that more than 50% of the population don't agree with you? You know that more than 50% of Congress, both the House of Representatives and Senate, doesn't agree with you. Would you, A, just say, this is really bad. It's a bad idea for the country. Even if I can win another election with it, it's really bad for the country. Or would you, B, completely abuse the system that that you took an oath more than anybody else, that you took an oath to support, and try to ram this through reconciliation, and then wonder why the international community goes, huh? And that's the other thing that's really important about all of this. Americans look at this as though it is an American domestic issue. Sorry, guys. You guys keep going around saying you're the world police. You guys keep going around saying that you're the world's best hope for freedom and liberty and all those sorts of things. And because you are the leaders of the free world, that means that the rest of us get to criticize you and get to pay a lot of attention. I bet you have absolutely no idea, Peter, Nick, Sasha. I bet you have absolutely no idea what the Reserve Bank of Australia currently is doing, what their next move is going to be, you've got no idea. Why would you?
I have one idea, Sasha. They're not going to default either. Nobody's going to default.
Of course, not going to default. But you have no idea what their economic outlook is and what they're doing. Australians know, maybe if they pay attention. Australians would pay more attention to that. But also Australians are going to pay attention to what's happening in the United States. And this is a really important point because the strength of the US economy comes from the fact that there is so much international money that flows into America that invests in America. So I agree with you, Peter. I seriously doubt the US would ever consider defaulting, not just because of the domestic implications, but because of the international implications of that.
And the political implications are the key for the Democrats.
The political the political stuff is
Sasha,
domestic.
Sasha, the thing is, look, but the Democrats and Biden have messed up so much already in the minds of the Americans, and rightfully so. The borders are open. People with COVID are flowing into the United States across the southern border. Something like 10% of the people they're just letting go have COVID, and yet they say they're protecting. Biden just got caught in a big lie on Afghanistan today. He told everybody that his advisors told him to pull out. But every military advisor just stood up in Congress and said, no, we recommended 2,500, 3,500, and he went against it. And he said all his advisors told him no. So Afghanistan, let me just sum and then you go, Sasha. But with Afghanistan is a problem, with inflation is a problem, which is going to get worse because the energy companies are probably going to really ram into Biden and the Democrats. And also they're pulling back on their exploration because of a lot of reasons. That's a whole nother discussion. But so with all the problems the Democrats have and the fact that there's questionable whether they even won the last election, I know that's controversial, but they're not going to want a debt default. Imagine going to the next election and politicians say they blew it in Afghanistan, they blew up our debt rating went down, they're collapsing the country. They can't let it happen.
Remember, though, I'm not consider myself to be a Biden's advocate, but
Since when? That's what you said during the election.
He was very cautious to say, to my best recollection. And for 78 years old man, maybe you can give him benefits of the doubt. So he was not outright lying, but his recollection failed him somewhat. I would. Let's make let's make 1 minute commercial break, and we will continue right after that. Okay.
No break. Maybe a break.
Okay, let's get some facts clear, please. The U.S. government has defaulted on the debt before. Just Grandmaster Kenneth Rogoff, who used to be the head economist, showed specifically we defaulted in 1790, 1841, 1873, 1933, and the latest was in 1979, a small short-term default. So to say, hey, we're not going to default and it's off the table, you can't do that. You got to assign a probability to it. What is it? Zero?
Not zero. Let me just address a couple of things that Peter said though, because I think that gets to the crux of the issue. Nick, to what you just said, if the US defaults today in a more modern society, I think that has grave consequences. Sasha, if Biden should be cut slack because he's very old, then he should be cut out of the executive branch of government. But let's go to. I really want to address what Peter said. Peter, everything that you said, I agree with. But I agree with. I'm not American, but hell, I might as well be with how much attention I pay to US politics. I agree with everything that you said, but almost everything that you said were US political issues. So what I'm concerned about is how the international investing community is going to view the United States. Now, is it a problem that there's, a whole stream of immigrants are coming across illegally over your southern border? It is domestically, absolutely. Is it an issue internationally for international investors? Well, the question is comparative to what? International investors are going to compare the United States to other advanced democracies, other liberal democracies, to see whether or not the United States, not whether the United States is strong, but whether or not the United States represents a better investing option than other advanced democracies. And my fear for the United States is not any of the things that you brought up, which are very valid. I hate a lot of the things that you said. I just look at it and go, why the hell are Democrats doing this? But from an economics perspective, I look at it and say, what will it take before international investors will say, you know what? I'm not sure the United States represents the safest place for my money. I'm going to invest it in the UK or Singapore or Japan or France or wherever, right? That's the big issue that I want to that I have to keep asking myself and satisfy myself. Even prior to this, that's always the question, because international money flow determines the buoyancy of the market or the deflation of the market.
Shaquille, the problem is with that is that the other countries have bigger problems or just as bigger problems in the United States. Every country has huge demographic issues that they're not addressing at all. Every country. China has the worst because they're one-child policy, then they're two-child policy. Now they have a three-child policy, and they're saying we need more kids. But the countries around the world, from South America to Europe to Asia, have these problems. And it's all, short-term. But look, Europe's already at negative interest rates in a lot of countries. The rest of the world is at very low interest rates. The United States just has to get there, which will take about 5 or 10 years. But so where are you going to park your money? You're going to put it in Japan that's dependent on energy so much. You're going to put it in China because you trust them. You're going to put it in in Taiwan or Singapore, where you have to, again, rely on the Chinese not taking over one day. And Europe is socialist, and they're having huge problems with productivity. They're more dependent than ever on the Russian natural gas. And they're having huge energy problems, by the way. And by the way, all this is my conclusion, is first of all, where we're going to see it spit out, besides housing prices, is energy. If it's going to come out, it's going to be in energy, this inflation. And because, Saudis, for instance, are going to say, we have a budget to meet and we want more money for it. And the world is not addressing the energy needs. And everybody has this story that we're going to shift to solar and wind, and it's going to be great and it's going to happen really quickly. But the oil companies are pulling back on exploration and development. And the reason is because they're saying we're concerned about the future. We're going to start returning some of the capital to our shareholders. So let me finish. Energy has been going up consistently this year. The oil's at $76 a barrel. But I wouldn't be surprised if it reaches 100, maybe next year towards the election, when the energy companies are probably going to go after the Democrats fiercely, just like the tech companies went after Trump, because they're going to say we hate these policies. And so energy is going to keep going up. It has to come out somewhere, all this money printing.
Peter, let me just say a couple of things as a response to you. When you talk about energy issues and what the world wants, no, that's what America wants right now. Commodity producing countries, especially like Australia, less so, but somewhat like Canada, they don't have those same views. So it's very easy to fall into the idea that everybody believes what is being pushed out by either Fox or CNN or the big media companies in the United States. It's easy to fall into that trap. But the rest of the world doesn't view things as black and white as what Americans generally do because of American media.
What about the Paris Accords? What about all that?
But not everybody agrees with that. There's a lot more as a percentage of our population. There's a lot a greater percentage of Australians that don't agree with the Paris Accord than there is Americans, even though Americans voted for Trump in not the last election, but the one before. A lot more, as a percentage of the population, a lot more Australians don't agree with it. So what you're seeing is a distorted view because of American media. But if I can just address the real heart of the issues of what you said there, it's not about whether or not I think that other economies are fundamentally stronger or not. What I look at, just me personally, what I look at when I move money around is where I think people think there's going to be the most amount of growth. So you talked about China. There's a very interesting question about India. India has a very similar population. Where do I see the most amount of growth? If I'm in the high-risk emerging markets area, I might very well consider India to be a better proposition than China. And this is the same thing when you look at the stock market. I might look at, a really, strong and safe company, Microsoft, or, like one of your big companies, 3M, one of those, and say, well, that's a safe place to put my money. But I'm also going to look at where do I think I'm going to get the most growth, even in the tech sector.
Wait, are you saying, though, that you do like India, or are you saying that you just theoretically might like India?
Oh, I say theoretical because I won't talk about what my actual positions are.
Well, why don't we talk about actual positions?
Well, because I run multi-billion-dollar hedge funds, and I'm not going to tell you what my positions are, Peter.
So theoretical.
But if you are going to look at tech companies, if you're in the tech sphere, do you look at Google and Apple and the FANG companies, or do you look at a smaller company that's a startup that might have more growth? And that's probably the issue when it comes to international money flows. Because it's not like international money is going to say, well, look, let's go and invest in Uganda. But the international money might say, I think Canada is a better option. Australia is a better option. New Zealand's a better option based on the potential growth that we see in those regions. That's where my concern would be on economic issues, not because I think the political situation in the United States is bad, which I do think, and not because I think the United States may have some poor economic outcomes. It's about where do I think there's going to be the most amount of growth, and that's where international money generally goes.
A couple of points I would like to make. Number one, Professor Regan will be on this coming Saturday chess show. Number two, one of my programs on the chess show was why chess players should be good at investing in the stock market or so on. And one of my biggest points was that both chess game and investing, they have one very important thing common for both. It's a recognition of patterns.
Right.
So when you learn in chess, okay, so there is a combination. Bishop takes h7 pawn, knight g5 check, queen h5 with a quick mate. Now, it doesn't mean that pattern will happen in every game, but there are several patterns. And for example, you shouldn't do that move because that would allow exactly that combination. So you have to select another move in order to avoid this combination, right? So in stock marketing, you see certain chart patterns. You see certain developments in politics, in larger macroeconomic environment, and so on. And that immediately translates in your mind, okay, this, unless, Peter, like if you're a very long-term investor and you have high-paying dividend stocks, then you're insulated from all that, because I even watched these high-paying dividend stocks, including those that I own, in all this turbulence on the markets. They went very little down, if anything.
They're like bonds.
Yeah, they historically, and we better transition into dividends and I'm not sure if you know this, Shaquille, but we have a new format we're doing.
Sure.
We're trying to keep it to 30 to 40 minutes now, the show. So we'll get into a dividend stock. But I might pick of the week. But dividend stocks have historically outperformed regular stocks by far, especially dividend growth stocks. And the ones that do the worst are the ones who either reduce dividends or don't ever pay dividends. And so that's why I like a percentage of my portfolio in dividend-paying stocks. So this week, I mentioned this a while ago, and it's up about maybe 15 or 20% since I mentioned it, but I still like it. Spartan Nash. Spartan Nash, it has a 3.6% dividend, which in today's market is pretty good. If you look at the history of its dividend growth,
Sorry to interrupt you, Peter. Unfortunately, audience, I do have to go. I've actually got some clients calling me. I will try to come back. Sorry, Peter, to interrupt you. I'll bid you. Thank you.
Right. Thank you.
Okay. Bye. Okay. So anyway, Spartan Nash, it's grown its dividend by 7% a year for the last 5 years, annualized, according to TD Ameritrade. Its EPS is up 4%. Its price to cash flow is 4.8 times, which means it's earning 20% of cash flow. So now I should have talked about the company first. They distribute grocery products. They're the 5th largest distributor of grocery products in the United States. And also, they're the #1 distributor of grocery products to the military in the United States. And so they have nice profit margins. And there's 2 big opportunities here. And they have very low debt to assets, by the way. But there's a few changes. First of all, their military operations have not been very profitable, and they're reforming them. So they could even increase that cash flow even more than the 20% they're making now. But the big thing was 11 months ago, they made a deal with Amazon. And this deal was the following. They have about 35 million shares outstanding. Amazon took warrants for 5.5 million shares. But what did Amazon give? Well, first of all, they gave them access to a lot of the groceries. So in that one deal, Spartan Nash increased their capacity to reach groceries by 160%. And Amazon wants to get into the grocery business big time. Obviously, they've bought Whole Foods, but they need distribution to do that. So they're not already they've already exercised the warrants. It was part of the deal that they immediately got over 1 million shares. They're not buying all these millions of shares because they don't think that it's a good opportunity. They think we're going to do a lot of business with this company and we want a piece of the action. They may even buy it eventually out, and that then would be at a premium. But in the meantime, they're working with Amazon to grow their business anyway. They've got a great track history. I have about 0.5% in there. So that's go ahead, Sasha.
Peter, what's the deal of that
SPTN.
SPTN, yeah?
Yeah, Spartan Nash. I don't know why it's underappreciated, but I'm nervous about the Krogers and the Albertsons of the world because they're going to have a lot of labor cost issues because it's hard to get people to work in your stores now. But this is the distribution. People have to eat. So when they bring the food over there, they get their profit margin. They've got the entrenched structures. And again, the opportunities for growth are really big here. I wouldn't put a ton in there because, one, I think energy is the place to be. We didn't get in time of it, but I have an interesting analysis of why. I was looking at Exxon because energy is definitely a place to be, I believe. There's so many more reasons now. But maybe next week we'll get into that. But I did a comparison of Exxon, which would be a stock I'd look at compared to MPLX and some of the MLPs, and it's so far off. It's like, why would either Exxon is valued at 3 times, or the MLPs and TRP are discounted 3 times. I think it's that the MLPs are so discounted. So, but I think we have to stop now.
Yeah. Okay. Nick, anything that you would like to address?
Well, I was just going to say, you got to assign a probability somewhere that our friends in Congress do the wrong thing. It can't be 0%. There's always a chance that
It'll be interesting.
Yeah, I mean, the thing is, there's a chance that they could actually default. Let's say it's not 0, it could be 5%. Maybe it's 10%. Well, if you got a 10% probability of losing 15%, or maybe having a $15 trillion loss, you got to figure out where your positions are going to be.
Nick, here's an interesting point, though. I have to throw this in. This is funny. So, Nick, if the Democrats default, it's going to highly increase the odds that they're going to lose power. So maybe that's a good thing for the market.
Well, maybe in the long run, you might be true.
1 year, the market.
Let's see. I'm following Sasha's theory: when you should get in, when you should get out,
right?
And preservation of capital. I can't get out altogether because I have some assets that are professionally managed, and it would take me a long time to talk to them to get out. But I can on some of my individual positions. Not all of them, obviously. MPLX.
Are you doing it though, or are you just?
I've already done it. I'm already out. Dude. I'll see you guys after October 18th. Then I get back in. Okay, but I'm not gonna sit around and go every day whether or not the client might. Could you imagine you had a board of directors who are dysfunctional, And all they discuss is whether or not we should default on our obligations. Would you invest in that company, Peter?
I think if there's default, I think if there's a US default in today's history and in modern history, regardless of who it is, whether it's Republicans or Democrats are in control of government at that time. When I say government, I mean the executive branch. Regardless of who is responsible for it, if there is a US default, the consequences will be significant. And I think the major thing
that's why they won't allow it to happen.
That would be called the major thing that would be called into question will be the US's role as a world reserve currency. And one of the worst things that could possibly happen is, we see this in every other economy and every other pegging. What happens if the Middle East, which almost every Middle Eastern country is pegged to the US dollar, what happens if the Middle East says, like they said to other countries before, you know what? We're done and we're depegging our currency. And worse, we're going to free float our currency. The US is over when it comes to debt. Because one of the big things,
energy prices will go up. Energy prices will go up.
But it's not just because your energy prices will go up, Peter. The biggest issue is that much of the reason why US politicians can promote things that will push inflation is the fact that there's an asset base behind them. And it's not just the US asset base. It's also the fact that world oil and other products from the Middle East actually are denominated in US dollars. If that ever ended, I think the US and the Western world have a few issues.
Okay, well, we've got to wrap up the show.
You're being very logical, but also on your board of directors who are making the decision is AOC and Bernie Sanders. Great.
Yeah. But
there's a problem.
What if your board of decisions just does whatever is good for them and not good for anybody else? So when you think of it that way, they don't want to default. And that's probably what they'll do.
Stay optimistic, Peter. I hope you're right.
It's not optimism. It's just reality.
Anyway, Sasha? It's a very interesting time. Don't forget that, as I said on a previous show, that politicians in Washington, they have three things what they're trying to serve. I'm not so sure about which priority. One is to serve a U.S. country. Another one is to serve their own party. And that third one is to serve themselves individually. And I'm not so sure which one will take over, but we will know more about it next week. And I'm looking forward to see you then, and we'll discuss the consequences. Thank you very much. It was Modern Investing on IBM TV. Bye-bye, everybody.